You're right, EMA crossovers do lag. And if you've been trading for any time at all, you've seen this many times, price breaks out, starts moving fast, and you're sitting there waiting for that EMA crossover to finally confirm. By the time it does, the move is already gone. You enter anyway, because now it looks official. And then what happens? 2 candles later, the crossover disappears, price pulls back, and your stop loss gets hit again. I've watched this play out again and again. Different traders, different markets, same frustration. And that's why I want to be very clear with you. EMA crossovers aren't broken. You're not stupid for thinking they lag. And you're not wrong for feeling like the market keeps faking you out. What's broken is how most traders are taught to use them. So in this video, I'm going to show you how professionals handle EMA crossovers, how to spot the fake ones before you enter, and how to use the 9 and 20 EMA in a way that actually lines up with price action. No extra indicators, no guessing, just a smarter way to trade something you already use. Before we go deeper, quick heads up. If this kind of practical trading breakdown helps you, make sure you're subscribed. That way you don't miss the next one. Now, if you're brand new and don't know how to add the 9 and 20 EMA to your chart, I've already covered that step by step in the previous video. You'll find the link in the description, and it'll also pop up on the screen. But if you're already comfortable with EMAs, let's get straight into the strategy. Let's start with the foundation. Why these two moving averages? The 9 EMA represents short-term momentum. It's fast. It reacts quickly to price changes. It tells you what's happening right now. The 20 EMA represents short-term trend direction. It's slower, more stable. It keeps you aligned with the bigger picture without being too far removed from current price action. Together, they give you the best of both worlds. You're fast enough to catch real momentum, but slow enough to avoid getting chopped up in noise. This isn't about catching tops and bottoms. It's about capturing continuation moves, those smooth, high-probability trades that happen when the market is already trending. Your chart setup is simple. EMA 9 in green, EMA 20 in orange. Both calculated from the close. That's it. Clean, simple, effective. Now, before we dive into the actual strategies, we need to establish something critical, the timeframes you'll be working with. This isn't something you figure out at the end. This is your foundation. Trade only 3 timeframes with this strategy: 15-minute chart, 1-hour chart, 4-hour chart. These are your sweet spots. They're liquid enough for clean price action, but not so fast that you're getting whipsawed every few minutes. Here's the confirmation rule, and this is non-negotiable. Never trade without checking the higher time frame first. If you're analyzing a setup on the 15-minute chart, confirm the trend direction on the 1-hour or 4-hour. If you're on the 1-hour or 4-hour, confirm on the daily chart. Why does this matter so much? Because a bullish setup on the 15-minute means absolutely nothing if the 1-hour chart is in a strong downtrend. You'd be fighting the current. You'd be picking up pennies in front of a steamroller. Always trade in the direction of the higher time frame. If the bigger picture is bearish, only take short setups. If it's bullish, only take long setups. This one rule will eliminate more losing trades than any indicator ever could. Market context matters too. If the overall market, whether you're trading indices, crypto, or forex, is moving strongly in one direction, align with it. Don't try to be a hero. Trade with the flow, not against it. Before you take any trade, you need to understand what kind of market you're in. Is it trending, or is it moving sideways? This matters because EMA strategies thrive in trending markets and fail miserably in choppy sideways conditions. Here's how you recognize the difference. In a trending market, candles show commitment. They're clean. They have strong bodies. Follow-through is there. You see higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. In sideways markets, what happens? Candles become smaller. They develop long wicks on both sides. Closes are weak. Price keeps reversing within a tight range. There's no momentum. There's no follow-through. Pay special attention to your alert candles, the candles that would confirm your entry. In a trending market, that candle should be slightly larger than average. Ideally, it engulfs the previous candle or covers most of its range. That's conviction. That's the market telling you it's ready to move. But if that alert candle looks timid, if it's barely breaking the previous high or low, if it's covered in wicks, if the body is tiny, just walk away. The market isn't ready. Don't force it. This small detail will save you from so many frustrating, unnecessary losses. Alright, now let's get into the first strategy. But before I explain it, I want you to test yourself. Take a look at this chart. You can see the 9 EMA just crossed above the 20 EMA. There's your bullish crossover signal. Here's my question. Would you take this trade? Will this breakout be successful? Pause the video right now and drop your answer in the comments. Just type yes or no. I'll wait. Alright, here's the answer. No. This breakout is going to fail. Why? Because the last two crossovers before this one didn't work either. The market is choppy, and this is just another fake signal. We're going to learn exactly how to spot this in Strategy 1. Here's the rule. Before you take any EMA crossover trade, look back at the last two crossovers. Did they work? Did price respect them and move in the intended direction? If both of those previous crossovers worked, meaning price followed through cleanly, then you can trade the next one with confidence. But if even one of those last two crossovers failed, you skip the next signal entirely. You stay out, you wait, you don't force it. Why does this work so well? Because trending markets repeat behavior. When EMAs are working, they keep working. When a market is trending strongly, each crossover leads to a meaningful move. The signals are clean. The follow-through is there. But in choppy sideways markets, EMA crossovers become traps. Price crosses back and forth. Momentum shifts constantly. There's no real direction. And that's where traders lose money. They keep trading signals that have no structural support. This simple rule forces you to respect market conditions. It automatically filters out choppy phases. You're only trading when the market is actually cooperating. Think of it like this. If the last two crossovers didn't deliver, why would the next one be any different? The market is telling you something. Listen to it. Let me show you what this looks like in practice. Imagine you're watching a chart and you see an EMA crossover. Before you even think about entering, scroll back. Look at the previous two crossovers. Did the first one lead to a clean move? Did the second one also work? If yes to both, you've got a green light for the next signal. But if you see that one of them failed, maybe price crossed, then immediately reversed, or maybe it barely moved at all, that's your warning. The market structure isn't supporting EMA signals right now. Wait for conditions to improve. This one filter alone will keep you out of more losing trades than you can imagine. Now let's move to the second strategy. And again, I want you to analyze this setup with me. Look at this chart. Price is in an uptrend. The 9 EMA is above the 20 EMA. Price pulls back to the EMA zone, forms a red candle, and then a strong green candle closes above that red candle's high. Here's my question. Would you take this trade? Will this breakout be successful? Drop your answer in the comments, yes or no. Don't scroll ahead. Really think about it. Ready? Here's the answer. Yes, this setup has a very high probability of success. Why? Because we have trend confirmation, a pullback into value, and strong candlestick rejection showing buyers are back in control. Let me show you exactly how this strategy works. We're going to combine EMA crossovers with pullbacks and candlestick confirmation. This approach is methodical, patient, and extremely effective when applied correctly. Step 1. Establish the trend condition. For a buy setup, you need two things confirmed. First, price must be above both the 9 EMA and the 20 EMA. Second, the 9 EMA must be above the 20 EMA. That's your bullish structure. That's your green light. At this stage, you're not entering yet. You're just identifying that the market is in a state where long trades make sense. Step 2. Wait for the retracement. Here's where patience comes in. You don't chase the move. You wait for price to pull back into the EMA zone. This could be a touch of the 9 EMA. It could be a slight overshoot. It could even be a brief dip below and then a reclaim. The EMA zone is your area of value. It's where buyers are supposed to step back in if the trend is real. You're not looking for perfection here. You're looking for structure. Step 3. Confirm the entry with a candlestick pattern. This is the most important part. When price pulls back into the EMA zone, You wait for a red candle to form, a candle that shows sellers pushing down. Then, you watch closely. The moment a green candle closes above the high of that red candle, you have your entry signal. But not just any green candle. This candle needs to be strong. It needs to show conviction. Look for a solid body. Small wicks are fine, but avoid candles with long wicks on both sides. That's indecision, and indecision doesn't give you an edge. Preferably, you want something like a hammer, or an engulfing candle, or just a strong bullish close that tells you buyers are back in control. Why does this approach work so well? Because you're layering confirmation. You're not just relying on the EMA crossover. You're waiting for structure, then waiting for price to test that structure, and then waiting for buyers to prove themselves with real momentum. You're trading with the trend, but only after the market shows you it's ready to continue. That's the difference between hoping and knowing. Now, everything I just explained flips for sell setups. The logic is exactly the same, just inverted. For a short trade, you need price below both EMAs. You need the 9 EMA below the 20 EMA. That's your bearish structure. Then you wait for price to pull back up into the EMA zone. You wait for a green candle to form, buyers trying to push higher. And then you enter when a strong red candle closes below that green candle's low. Same rules, same discipline, same confirmation process. The beauty of this strategy is its symmetry. Once you understand it in one direction, you understand it in both. This isn't about taking every signal, it's about taking the right signals. This video is for educational purposes only. I am not a financial advisor. All examples shown are for learning and explanation only, and the charts used in this video are from tradingview.com. Trading involves risk, and past performance does not guarantee future results. Always do your own research and practice proper risk management before making any trading decisions.